Our annual outlook is titled Investing for the Future. And this future will bring both big opportunities, not just around artificial intelligence, but also challenges. The global economy is in flux and new technologies are also redrawing the economic map. The aim of our outlook is to show where the global economy and markets are going and how investment portfolios can benefit from this, identifying opportunities, actively managing risks.
On US-China relations, a degree of pragmatism is back. There was a tariff truce at the start of November, which has helped ease some of the immediate concerns between the two nations. But this is not fundamentally a stable situation, and there has not been a strategic pivot from either side. Geopolitical rivalries have multiple dimensions. In this instance, technology and geopolitics are too closely intertwined. For China, access to high-end semiconductors and cheap and reliable energy remains at the center of their decision-making. For the US, reducing dependency on China is now a national security priority, and tariffs are a central tool to secure technological leadership and supply chain resilience. Both countries have powerful trade levers to support these objectives. The US can limit exports where it is a market leader, for example, in advanced semiconductors, while China can restrict exports of rare earth metals where it has a dominant position. These are real strategic commodities with few other geographic sources or substitutes. But both these countries are acutely aware that tariffs and other restrictions have costs, both for its corporations and consumers. That should discourage further tariff action, at least for now.
Tariffs was a great topic for 2025. Politicians tend to think about the global trade as a zero-sum game. That is not good for their own economy and is not good for the global economy because global trade brings actually a lot of welfare to the people. So for 26, it would be great if politicians could think about tax rate decreases, decrease in bureaucracy, to strengthen their own economy and not to protect it against competition, because competition, particularly on a global scale, is always good for better products, for better services, and for lower prices.
Commodities are at the heart of today's global context for economic and strategic advantage. The battle is fierce around rare earth and critical minerals, essential for everything from AI servers and EVs to wind turbines and defense systems. Emerging markets, especially in Asia, are both battlegrounds and beneficiaries. They control much of the world's mining and processing capacity and are now attracting investments as companies and countries seek to diversify away from single-source dependencies. For investors, this means the race for resources is intensifying. We expect continued efforts to find substitute for rare earths, but these are hard to replace in the short term. The bottom line, commodities are no longer just cyclical, they are strategic. The context for control, especially in rare earth, will shape global supply chains, drive policy, and create both risk and opportunities for portfolio in 2026 and beyond.
Alternatives have a role in many portfolios. They can help with diversification or get access to sectors, but underrepresented in public markets. And thanks to new regulation frameworks, access to them is now becoming easier. For us, one current focus is infrastructure. Globally, the need for infrastructure is immense, including energy, transport, and sustainable transformation. Alternative investments here can offer the potential for relative stable returns or stronger capital appreciation, but with, of course, projects and development risks. One infrastructure issue likely to remain prominent is that of energy and data centers. These are needed to fuel the artificial intelligence revolution. Investment to get this right is needed for us to achieve, as I call it, sustainability plus X. To combine sustainability, growth, and social support, and long-term economic resilience in the real world. But also, most importantly, in your portfolio.
For us, investing beyond the benchmark means to stay invested in technology stocks, the liquid stock markets. That served us very well over the last 15 years or so. But we are, of course, planning for the next few years. And here we want to see a robust asset allocation involving also private markets, because by these alternative investments, namely private equity and infrastructure, we can also address different return sources and risk sources, so that the overall investment actually is much more diversified, something that we need to be aware of, because it's not only about risks and opportunities, it's really about stabilizing our investments for the years to come.